Without further ado, let me start with the first conversation and let me introduce my first guest. This is Amol Joshi, who is the founder of Plan Rupee Investment Services. Thank you so much, Amol, for taking the time. And I think this is a very important conversation to have. When people invest in mutual funds, they don't necessarily look at what the philosophy of fund managers are. In fact, they are more focused on the returns that have been generated in the recent past or over the last 4 or 5 years, and what exactly the fund is supposed to do. But how important do you think is understanding the philosophy of a fund or a fund house?
Alex, good evening. Thanks for having me on the show. Always a pleasure. To answer your question in one line, it is very, very important to understand the philosophy of fund management or the fund manager, the scheme in which you are investing. Now, a bit of an explanation. Fund management philosophy is nothing but you can consider it as a lifeblood, or you can consider it as an engine that drives the scheme and ultimately as the end result its performance as well. As you mentioned in your opening piece, there are quite a few investment philosophies, right from quality, growth. Sometimes these are used interchangeably, but let's still talk about them. Quality, growth, way of managing funds. Then there is value investment, value investing. Then you have growth at reasonable price. Then you have dividend yield. There are many of them, but predominantly in Indian markets as well as global markets, you would see the way in asset classes, debt and equity dominate a large part of conversation. So similarly, out of the half a dozen philosophies that we spoke, that I mentioned just now, listed just now, I think quality, growth and value, these two or three segments, these two or three philosophies take a lion's share of the discussion. So the bottom line is very, very important to understand the fund management philosophy if you are investing into a mutual fund.
So let's illustrate this a little bit more, Amol, and perhaps you can take the example of one of the approaches that you spoke about to illustrate your point. What happens when you do not match your own expectations to the philosophy of a fund manager? How badly can it go wrong?
Right. So let's talk about, let's take one of the examples. Let's take something called as growth or quality oriented philosophy of fund management. Let's talk about growth. So growth, typically the word itself is self-explanatory. You invest, you first and foremost, out of the given landscape, given universe, you try to identify companies that are growing their businesses consistently. Now, when companies grow their business consistently, no prizes for guessing that their top line, bottom line, as in their sales as well as profits, not necessarily, but you assume that if company is any good, I think their profits will also keep in line over a long period of time, not necessarily quarter on quarter. And companies that manage to do that, share market, stock market does not miss them. Stock market necessarily identifies these companies that are able to consistently grow their businesses, profits year on year, quarter on quarter. Now, what happens is when stock market identifies, essentially stock market rewards the company by way of increasing their share prices, by bidding up their share prices. This is, in simple terms, this is nothing but a growth investment philosophy. Now this sounds very simple, but suffice to say that it's not very easy. A company essentially does not, there are no two categories that this is a growth oriented company and this one is not. You will have to look at their businesses, you will have to look at their track record, you will have to look at their history of generating profits or generating business growth consistently, and ultimately stock price will go up and you will be rewarded. Now, this is called as growth investment philosophy. On the other hand, as I mentioned, it is almost used as the other side of the same coin. Value investment philosophy actually tries to identify companies that are currently, very simply put, that are currently out of favor of the market. In the sense, the company does well, companies generating consistently, churning out cash, companies are probably low leveraged as well. But for one reason or another, and we have several examples here, we'll not go necessarily into stocks, but we have several examples where companies that is kind of a multinational company, India-grown company, but the stock price does not increase for quite some time. Now, a fund manager who identifies companies like that and bets on them when the prices are low, with a hope that ultimately the price will catch up with fundamentals. This is the value investment philosophy in very, very short, in very short explanation. Now, the second part of the answer is what happens when your thought process, you as an investor, is not aligned with thought process of the fund manager. Value essentially will underperform in booming phases of the market where only few companies take the index along. Now, we all remember the phase between 2018 to somewhere mid of 2020, when only few companies, handful of companies out of Nifty 50 drove the index to the heights. Many companies, sectors were not doing well, including pharma sector was not doing well for previous 4-5 years. Now, those sector and companies, there was nothing fundamentally wrong with them, but simply the companies are out of favor of market for one reason or another. What happens when there is a mismatch between you as an investor and fund manager's philosophy is you will, despite of the fund sticking to its core competence or sticking to its philosophy, you will not see the results. You will not find the growth in your NAVs, the returns generated by your fund, not in line with the market. And ultimately, you will end up getting disappointed. Now, what happens after that? After 2020 crash and then broad-based recovery that we saw and we are still seeing, we are still in the middle of it. In such events, value funds came back, and for a certain period of time, for last 1 or 2 quarters, value funds have in fact outperformed growth funds as well. And that's the reason why you should have a very clear understanding of what kind of investor you are, what kind of temperament as an investor you have, and the scheme that you have chosen, whether it is a right fit for you or not.
That's very well elucidated, very nicely explained how important this is and how jarring it can be if this is not matched. You've elucidated, I think, very clearly what growth is and what value is. You mentioned a couple more. You said there is a dividend yield approach, and there is also a growth at an affordable price.
Yes.
What do these entail?
Right. So GARP, growth at reasonable price, and dividend yield. Now, dividend yield, if you go by classic definition of dividend yield, again, the term is almost always the self-explanatory part of it. There are companies that steadily generate cash. There are companies that steadily reward their shareholders by way of dividends. How does that happen? Which companies typically? Now, again, as I'll use the word classic again. Classic example of this is suppose something like a power company, power utility company. No matter what happens, your power consumption will not double or treble in terms of 3 months unless something extraordinary happens. Similarly, no matter what, something goes wrong, your power consumption in your household and overall you will not be able to reduce it by 80%. So what happens is these companies have predictable line of businesses such that revenues as well as top line is very predictable, and that gives them the ability of giving out the dividends year on year. Most of the times dividend taxation is better. I'm not saying taxation is inherent part of dividend yield fund management philosophy, but for investor it helps by quite a lot earlier. Now that difference is not there from last 1 year or so, because dividends are now taken into account as your income from other sources. But in the earlier era, it used to be very important because dividends were tax-free, or there was a 10% dividend distribution tax. Considering all of this, this also was one of the theme that had quite a few funds in the Indian fund management industry. Growth at reasonable price, as the name suggests, all the parameters of growth, but you will not buy the company at any valuation. Now, what do I mean by valuation? If you buy a company at exorbitant price to earning multiples or exorbitant price to book multiples, there are chances that when the tide turns, when the market boom kind of recedes, then the P multiples will come back to their mean, come back to their long period averages. Now, you avoid that by investing into companies. You have your shortlist of companies, but you will wait for them to come at the price at which you are comfortable with. Again, there are very many calculations that you can do, but on the projection, suppose you intend to grow your portfolio by, let's say, 15%, assuming that market grows at the rate of 12-13%. Unless you, all the profit figures over next 3 years, over next 5 years, unless the price comes in the ballpark of where it is likely to generate a 13, 14, 15% kind of returns, you will wait, you will not buy those companies. That is, in short, growth at reasonable price. I mentioned earlier that growth and quality are almost used synonymously, but there is a difference in that. Within quality, there are two types broadly. You can again split them into two. You will look at quality businesses. Quality businesses are businesses that have moat around them. Quality businesses are businesses where there is a duopoly or oligopoly kind of situation, the entry barriers are very, very high. That's one aspect, quality business. Very important aspect, and these days you also know that aspect by a different name of ESG. The other important aspect is quality management. You want a management that's very, very fair, that is transparent, that does not venture, that sticks to its core competence. If you're a soap company, you do not necessarily want management to venture into an airline. That would not be staying with your core competence. So quality of business, quality of management, when these two things come together, I think that's one more aspect by which the funds are managed, which is quality way of managing funds, fund management philosophy. Alex.
Okay. Okay. Amol, I think you've broken it down very beautifully, and you've talked about the various approaches that fund managers could potentially have. You've also spoken about why an individual should understand these philosophies. And I think if a viewer is wondering where they can understand this, it's mentioned very clearly in the documents that are shared at the time of the launch of a fund, and also on a periodic basis, and also in conversations that fund managers have with yours truly on this program. We've got one of those lined up for you in just a short while. Amol, thank you so much for joining in and for explaining this very important concept. Always a pleasure speaking with you.
As always, a pleasure. Thank you. Thanks, Alex.